Hi friends, good day. Today let us try to understand about what is bad debt, what is bad debts expense, how to calculate bad debts expense, how to estimate bad debt expense through this video. According to Stephen Wright, bills travel through the mail at twice the speed of checks. Before we go in,
please subscribe for more videos. Click the bell icon for updates.
bad debts. Bad debts are those accounts that cannot be collected anymore or become uncollectable. Bad debt is a risk for all the businesses that extend credit, and there is a chance that the account can become uncollectable. These are recorded as bad debts expense in the balance sheet. Bad debt expense happens when the accounts to be received are no longer collectible because of the customer's inability to pay or fulfill their obligation to pay an outstanding debt or credit due to financial problems or bankruptcy. Bad debt expense is also referred as uncollectable accounts expense or doubtful accounts expense. This happens not only in financial institutions but also goods and services company when a company have already delivered the goods or services and the customer did not pay the amount owed. There is always a risk of default risk when extending credit to a person or a company. For example, if you do business on credit and have offered your customers to pay the amount owed in EMIs, that is monthly payments, eventually you will run into a customer who will not or cannot pay the amount. When this happens, that the amount to be collected becomes uncollectable, it is called bad debt. When you finally give up on collecting that debt and decided to remove it from the accounts, that is need to be recorded as an expense. This is called bad debt expense. How do you find this bad debt expense? It is an individual's or company's decision to write off the debts as bad debts. When a customer is avoiding the calls, not making any effort to negotiate the terms for more than 90 days, it can be written as bad debt expense. Writing off these as bad debt expense gives you a correct picture of your financial status, not overstating your revenues or assets and any earnings from those assets. Calculating bad debt expense. There are two methods used in recognizing and calculating credit losses. They are 1. Direct write-off method. In this method, the uncollectable accounts are written off directly to expense as they become uncollectable. The bad debt expense account is debited and the accounts receivable account is credited. There is a downside to this method. While this method writes off the exact amount of uncollected debts, it fails to uphold the matching principle used in accrual accounting and GAAP, that is, generally agreed accounting principles. The rule is that an expense must be recognized at the time of transaction rather than at the time of the payment. Number 2. Allowance method. In this method, the bad debts are anticipated even before they occur. An allowance for the doubtful accounts is made based on an estimated figure. It provides an estimated amount of uncollectable accounts in the same time as the revenue is generated. This is the amount of money that the company anticipated losing every year. When an account enters a sales transaction, bad debt expense is also entered. It will debit the bad debt expense and credit the allowance account. The allowance for the bad debt expense is a contra asset account, which means it reduces the total value of the receivables and are balanced out when both the balances are listed in the balance sheet. A contra asset account is a negative account that reduces the value of the asset account with which it is paired. Estimating the bad debt expense. There are two approaches used to estimate the bad debt expense. They are: Number 1. Percentage of accounts receivable method. In this approach, the company finds the estimated value of bad debts by calculating the bad debts as a percentage of the accounts receivable balance. For example, at the end of the accounting period, your company has an amount of Rs 5 lakh in your account receivables. The previous records indicate that an average of 10% become uncollectable. You need to set aside an allowance for the bad debts accounts to have a credit balance of Rs 50,000, that is 10% of Rs 5 lakh. Number 2. Percentage of sales method. It involves determining the percentage of total credit sales that is uncollectable. The past experience with the customers plays a major role in determining this percentage. For example, for an accounting period, the company reported Rs 5 lakh of net credit sales, and using the percentage of sales method, they calculated 10% of their credit sales as uncollectable. So Rs 50,000 will be the bad debt expense set aside. Well, thank you so much for watching. Please like this video and do share.